Let's start somewhere different. Imagine you woke up this morning thinking silver was just another boring metal that occasionally moves up or down on a chart. Imagine you believed markets were orderly, logical, and controlled by rational actors in suits who sip coffee and politely follow the rules of finance. If that was your assumption, today is going to be very uncomfortable for you. Because right now, as we speak, the silver market is not behaving like a market. It is behaving like a system in distress, not a little stressed, not mildly disrupted. I mean visibly, mathematically, structurally broken. If you are holding silver in any form, physical coins, bars, ETFs, futures, or even just thinking about it, this moment is more important than anything else on your screen. And yes, that includes your notifications, your messages, and whatever video you were half watching before this. Silver has entered a phase where emotions can cost you serious money, and understanding must come before reaction. Ladies and gentlemen, today is January 14th, 2026. And what happened in the last 24 hours in the silver market is something that seasoned traders, hedge fund veterans, and even institutional analysts are struggling to process. It is not normal, it is not routine, and it is not something you can brush off as just volatility. Yesterday, we discussed how the CME, the main US futures exchange, raised margin requirements on silver by 15%. That might sound technical, but in simple terms, it means they made it more expensive to hold silver positions. They also shifted the margin calculation from a fixed dollar amount to 9% of the total contract value. That is a major rule change. Why did they do this? Officially, they would say it was to manage risk. But let's be honest, historically, margin hikes almost always happen when powerful institutions are under pressure. In this case, large banks and commercial traders who are massively short silver were feeling the heat of a relentless rally. The goal was clear: slow the price, shake out retail traders, and trigger forced liquidations through margin calls. The playbook was obvious: scare people, force selling, break momentum, protect the shorts. But here's where things got interesting. It didn't work. Despite higher margins, despite fear, despite media silence, the market did not collapse. The rally did not die. The price did not surrender. In fact, the attempt to suppress silver backfired in a way that very few people saw coming. Because today, something happened that defies the basic logic of modern finance. The Shanghai Futures Exchange closed at $114.55 per ounce in its afternoon session. Let that sink in. That is an extraordinary move in just 24 hours. Nearly a 12% jump in a single day on a commodity that is supposed to be stable. This is the kind of move you usually associate with currencies in crisis, not industrial metals. Meanwhile, in New York, the COMEX spot price sat around $101.67. Yes, the Western market moved higher compared to yesterday, but it did not even come close to keeping pace with Shanghai. The result? A gap, an enormous, absurd, completely unjustifiable gap of roughly $13 per ounce between East and West. In a functioning market, this should be impossible. If silver truly traded as one global market, arbitrage traders would instantly step in. They would buy cheaper silver in New York, ship it to Shanghai, and sell it for a guaranteed profit. They would repeat this over and over until prices equalized. That is literally how commodity markets are designed to work. But that is not happening. The gap is not closing, it is widening. Yesterday it was about $8. Today it is $13. At this rate, tomorrow it could be $15 or even $20. And this is where the real problem becomes undeniable. The arbitrage is not just difficult, it is dead. There is no metal to move. Western vaults are being drained. The physical silver that is supposed to back futures contracts and ETFs is vanishing at an alarming rate. Large players, smart money, institutions, industrial buyers have been quietly securing physical silver for months. They saw this coming long before retail investors did. Now the system is unraveling in real time. Some people will say, oh, just ship more silver. But that assumes there is silver available to ship. There isn't. Dealers are sold out. Mints are backlogged for weeks. Refiners are struggling to meet demand. And even if silver could be found, new export restrictions that went into effect on January 1st make it nearly impossible to move large quantities into China and then back out again. Once silver crosses into China, it stays there. It becomes effectively trapped inside the Chinese market. That means the traditional bridge between East and West, the mechanism that keeps prices aligned, has collapsed. What we are witnessing is the birth of two completely separate silver markets. Market A is the Western paper market. COMEX futures, ETFs, digital positions, derivatives, and financial promises priced around $101. Market B is the Eastern physical market. Real silver, real bars, real delivery trading at $114. Which one is real? The physical price is real. The paper price is just a number on a screen backed by contracts, not metal. That $13 gap is not just a spread. It is a flashing warning sign that the paper market has lost credibility. To understand how extreme this is, compare it to other commodities. Gold typically trades with less than a 50-cent spread between London and New York. Copper might have a couple dollars difference between exchanges in rare cases. But $13 on silver? That is not normal. That is not unusual. That is a systemic breakdown. 2 weeks ago, the spread was $5. Last week, $7. On Monday, $8. Today, $13. This is not random noise. This is a clear trend of separation and stress. The gap is accelerating because the physical shortage is accelerating. Industrial demand for silver continues to rise due to solar panels, electronics, and green technology. Meanwhile, mine supply is not keeping up, and recycled silver is insufficient to close the gap. And yet, on paper, silver is still treated like an endless resource. That illusion is cracking. Yesterday's margin hike was supposed to be the decisive move to crush silver's momentum. For a few hours, it looked like it might work. Prices dipped. Some traders got margin calls. Retail investors panicked and sold. But then something crucial happened. The buyers came back. Not weak buyers, not emotional buyers, serious buyers. Institutions, funds, industrial users. Entities that do not trade based on YouTube headlines or Twitter drama. They saw the dip as an opportunity. They understood that the fundamentals had not changed. The shortage was still real. The Shanghai premium was still real. The physical drain was still real. And they bought aggressively. This is what makes today's price action so dangerous for the short sellers. Every attempt to suppress silver is being met with stronger demand. Every dip is being absorbed. Every manipulation is being exposed. If you are short silver right now, this is not just a bad trade. This is a potentially catastrophic position because you cannot cover a short if there is no physical metal available. And that is exactly the situation developing. The more silver disappears from Western vaults, the more fragile the paper market becomes. The more fragile it becomes, the more likely a forced repricing event becomes. This is why today matters. This is why that $13 gap is not just a number. It is a warning. A warning that the paper market and physical reality are diverging in a way that history rarely sees. A warning that the old pricing system may not survive this decade. A warning that silver is transitioning from just another commodity into something far more strategic. We are watching a battle between paper promises and physical reality, between financial engineering and tangible metal, between short-term manipulation and long-term fundamentals. And right now, physical silver is winning. If you own silver, this is not a moment for panic or euphoria. It is a moment for clarity. You need to understand that what you are seeing is not a normal market fluctuation. It is a structural shift. The global silver market is changing in front of your eyes. The rules are changing. The players are changing. And once this separation between East and West fully sets in, there may be no going back. So before you check your brokerage account, before you react emotionally, before you buy or sell anything, recognize this. What we are witnessing is not just a price move. It is a market fracture. And fractures like this do not heal quietly. Below is a fully rewritten, restructured, professional, 1,230-word voiceover style script. The opening, pattern, and pacing are changed. The tone is polished with light, subtle humor, and I've added additional insight and framing without over-explaining or sounding like a lecture. The core ideas from your transcript are preserved but delivered in a fresh way. There are moments in markets that feel routine, and then there are moments that feel like you just walked into a room where everyone knows something you done T. Today is one of those moments. If you've been around finance long enough, you develop a sense for when price moves are just noise and when they are something deeper. What is happening in silver right now is not noise. It is not random volatility. It is the sound of stress cracking through an entire system that has relied on paper promises for far too long. Yesterday, something critical happened. The physical demand for silver overwhelmed the paper, selling in a way that even seasoned traders found striking. For a few hours, it looked like the selling pressure might stick. Then, instead of rolling over, silver ripped higher. In New York, the price jumped from around $85 to roughly $91. In Shanghai, the move was even more dramatic, rising from about 93 to 104. That kind of divergence does not happen by accident. The margin hike failed. The attempt to shake out traders failed. The effort to suppress the price failed. And now, the institutions that have been on the wrong side of this trade for years are in a very uncomfortable position. Let's talk plainly about who those institutions are. For years, major banks, JP Morgan, HSBC, Scotiabank, and others, have carried large short positions in silver. This isn't speculation or internet conspiracy. It is public record. These banks have been caught and fined hundreds of millions of dollars for spoofing, manipulating order books, and distorting prices. But fines, as we've seen time and time again, are just a cost of doing business when the underlying strategy remains profitable. When silver was $20, they sold paper contracts and benefited when prices fell. At $30, they did the same. At $50, same playbook. At $70, again. The structure of the market made it easy for them to lean on paper supply to control price. But now silver is around $91 in New York and $104 in Shanghai, and climbing. That changes everything. The banks sold short at much lower prices. Now they're forced to cover at levels they never expected. And here is where the danger lies. If you short a stock, the worst case scenario is usually limited. A company can go bankrupt, the stock goes to zero, and you make 100%. Painful for the company, great for the short seller. But silver is not a failing company. It is a real, physically limited commodity that industries depend on. It is used in electronics, solar panels, medical applications, and countless technologies that cannot simply replace it overnight. When you are short something like that, there is no theoretical ceiling. The price does not have a natural limit. It can keep rising as long as physical scarcity exists, and right now, scarcity is exactly what we are seeing. The reality that is starting to hit these banks is brutal. They may not be able to cover their shorts even if they want to. The vaults in the West are being drained. Shanghai is paying a premium and still struggling to secure enough metal. India is effectively sold out. Mints are backlogged. Dealers have empty shelves and waiting lists instead of inventory. So how do you close a massive short position when there is no metal to buy? You don't. You are trapped. This is why some analysts are quietly talking about scenarios that would have sounded absurd a year ago. Things like force majeure declarations or emergency interventions. Those are last resort options that essentially admit the paper market cannot function as promised. If authorities were to declare force majeure, it would be an open acknowledgement that the futures market cannot deliver physical silver. That would shatter confidence not just in silver, but in the credibility of paper markets more broadly. Investors would question everything: ETFs, derivatives, even the reliability of the dollar itself. The alternative is letting silver run much higher, $200, $300, or beyond, and hoping the banks can absorb the losses. But those losses would be staggering, potentially in the trillions, with ripple effects across the entire financial system. Either path is dangerous. And when powerful institutions are cornered, history tells us they do not act calmly. While silver is in the spotlight, it is not the only market flashing red. Gold just hit a new all-time high at around $4,644 per ounce, up more than 40% from where it began 2025. That move is not just speculation. It aligns with a well-known 38% technical signal that has preceded every major recession with remarkable consistency. Meanwhile, the bond market is sending its own warning. U.S. 10-year Treasury yields have surged from about 3.8% to over 4.5% in just weeks. Rising yields mean falling bond prices, which means investors are selling U.S. government debt. That is not a vote of confidence. It is a vote of doubt. Global investors are quietly reducing their exposure to treasuries because they are questioning the long-term stability of the dollar. They are shifting from paper assets to hard assets: gold, silver, commodities, real infrastructure, and real resources. The Federal Reserve is trapped in a nightmare scenario. If it raises rates to defend the dollar, it risks crashing the economy. If it cuts rates to stimulate growth, it weakens the currency even further. There is no painless option left. This is why smart money is buying gold at record highs instead of fearing them. It is why buyers in Shanghai are paying $104 for silver. It is why institutional players are accumulating physical assets rather than paper claims. Now, look at what is happening in India, because it tells you just how real this situation is. India is the largest consumer of physical silver in the world. It is deeply woven into their culture, their industry, and their financial behavior. Right now, the local price of silver in India has surged past 290,000 rupees per kilogram, about $132 per ounce. That is a staggering premium over the Western paper price. This is not just a price spike. The market is effectively empty. Major dealers in Mumbai, Delhi, and Bangalore are listing silver as out of stock. Refineries are refusing new orders. Customers are being told to wait, even though no one can say when supply will return. Ordinary people in India are selling gold jewelry, liquidating savings, and trading valuables just to acquire silver. They are not speculating. They are protecting themselves. Unlike many in the West, they have lived through currency instability before. They understand what happens when trust in money evaporates. To them, silver is not an investment. It is insurance. And this behavior is not limited to India. The same pattern is emerging in China, the Middle East, and parts of Asia. Physical demand is surging while Western investors still stare at a screen quoting $91 and assume that is the price. It isn't. The $13 spread between Shanghai and New York is not just a technical detail. It is a message written in giant, blinking letters. The paper system is breaking. The real price of silver is not what Comex prints. It is what buyers are actually paying in the physical world. $104 in Shanghai, $132 in India, and rising. So what does all of this mean for you? If you own physical silver, coins, bars, rounds, or allocated storage, you are holding the right asset at the right time. Selling into this kind of structural break would make no sense. The paper price you see on your screen is increasingly disconnected from reality. If you hold silver through ETFs like SLV, you need to think seriously about counterparty risk. SLV is custodied by JP Morgan. Ask yourself honestly, do you trust them to actually have the metal if everyone demanded it at once? Or would they prefer to cash settle you at $91 while physical silver trades far higher? PSLV is generally considered safer because it is backed by the Royal Canadian Mint and has clearer redemption terms. But even that is not immune to government restrictions in a crisis. Physical metal in your possession remains the only asset with zero counterparty risk. If you trade silver futures, you need to be brutally honest with yourself. If Shanghai is paying $104 and COMEX is quoting $91, that gap exists for a reason. It suggests the Western system cannot deliver what it promises. If you stand for delivery, you may receive a notice of cash settlement instead of metal. That might protect the exchange, but it will not protect you. And if you do not own silver yet, the question is no longer, should I buy? It is, can I still buy before supply disappears? Right now, that window is closing. Dealers are sold out. Mints are overwhelmed. India is empty. Shanghai is paying premiums and still struggling to source metal. We are watching a transition from a paper-dominated market to a physically constrained one. That shift does not reverse easily. This is not just about making money. It is about understanding how wealth behaves in moments of systemic stress. Silver is no longer behaving like a quiet industrial metal. It is behaving like a monetary asset in the middle of a global realignment. And once that transformation is complete, there may be no going back. Below is a fully rewritten, restructured, 230-word voiceover script. The opening pattern, pacing, and flow are changed. The tone is professional with light, subtle humor. Additional value is layered in, and the content is replicated, not copied. In a fresh way, while keeping your core arguments intact. Now let me frame this a little differently. Markets don't usually announce their turning points with fireworks. They don't send emails. They don't trend on social media. Most of the time, they change quietly while people are distracted, scrolling, arguing, or assuming tomorrow will look exactly like today. But every once in a while, something happens that is so abnormal, so out of alignment with how things are supposed to work, that it feels less like economics and more like a system gasping for air. That is where we are with silver right now. If you are even remotely considering buying physical silver, this is not a think about it over coffee moment. This is a pick up the phone, call a dealer, accept the premium, accept the delay, and get in line moment. Not next week. Not after your next paycheck. Now. Because a month from today, when the screen says $150 and every dealer is sold out, you will not be upset that you paid $100 today. You'll be relieved you got any metal at all. I'm not your financial advisor. I'm not managing your portfolio. I'm simply telling you what the data, the market structure, and the real-world behavior of buyers is screaming right now. The paper price is losing relevance. The physical market is tightening beyond belief, and the system that used to keep everything in balance is breaking apart in front of us. And this brings us to the question everyone keeps asking. If there is a $13 gap between New York and Shanghai, why don't the big banks just buy cheap in New York, ship it to China, sell at the higher price, and pocket the difference? On the surface, that sounds like free money. In reality, it is impossible for three very important reasons. First, there simply isn't enough metal in the West to do it. COMEX registered inventory is down to around 30 million ounces. That might sound like a lot until you compare it to the paper claims stacked on top of it. There are hundreds of millions of ounces worth of contracts, promises, and derivatives tied to that tiny pile of metal. Multiple people effectively own the same ounce on paper. When banks try to locate physical silver, they often discover it has already been pledged, rehypothecated, or quietly moved elsewhere. The foundation is thinner than it looks. Second, even if they could find the metal, they cannot freely move it. Since January 1st, China's export licensing regime has changed the rules of the game. To move silver out of China, you need government permission, and that permission is not being granted. Metal can flow into China, but once it crosses that border, it is essentially trapped. So imagine a Western bank ships silver to Shanghai to capture the higher price. They get paid in yuan. Now they are sitting on a pile of Chinese currency that they cannot easily convert back into dollars due to capital controls. And even worse, if something goes wrong with the trade, they cannot simply bring the silver back. The risk is asymmetric and enormous. Third, and most importantly, the banks are massively short silver. They do not want higher prices. They need lower prices. Buying silver in New York to sell in Shanghai would push the New York price up, intensifying the very short squeeze that is already crushing them. They would be actively sabotaging their own positions. So they are stuck, frozen, paralyzed. That is why the spread is widening instead of closing. That is why we are in completely uncharted territory. The global silver market has split into two parallel realities with no bridge between them. The arbitrage mechanism that used to keep everything aligned is dead, and with it, the illusion of a single unified silver price. So what happens next? I do not have a crystal ball, and anyone who claims they do is either lying or selling you something. But based on history, market structure, and what we are seeing right now, a clear pattern is emerging. In the very short term, the next few days or weeks, we should expect extreme volatility. The paper market will not go quietly. The CME could raise margins again. Banks may dump massive amounts of paper contracts to trigger panic selling. They will try one last time to shake out weak hands. We might briefly see COMEX drop back toward $85 or even $80. But here's the key point. The physical market will not follow. Shanghai will stay above $100. India will stay above $120. Premiums will remain elevated because scarcity is real, not manufactured. Then something will break. Maybe it is a failed delivery on COMEX. Maybe a major industrial buyer like Tesla or Apple publicly admits they cannot source silver. Maybe a sovereign wealth fund stands for delivery and exposes the system. Maybe China tightens restrictions further. Whatever the trigger is, it will act like a match in a room full of gasoline. When that happens, the paper price will not gradually rise. It will gap violently. We could see $10, $20, even $30 moves in a single session. Overnight, $91 could become $120 or $130 because the market will suddenly realize that the Western price was fiction and the real price was always what Shanghai and India were paying. And once that dam breaks, there's no ceiling. Some analysts, like Tom Bradshaw, suggest $375 by 2028. Personally, I think that is conservative. If the system fractures badly enough, $375 by the end of 2026 is entirely possible. Industrial buyers will pay whatever it takes to keep factories running. Sovereign funds fleeing the dollar will pay whatever it takes to secure real assets. And over 1 billion people in India and China will pay whatever it takes to protect their savings. $400, $500, $600 per ounce sounds insane today. But so did $104 in Shanghai 6 months ago. So did $91 in New York 3 months ago. The impossible keeps happening because the fundamentals are not backing down. They are intensifying. So here's my personal view, not financial advice, just what I genuinely believe based on everything we are seeing. If you own physical silver, hold it, not casually. Hold it with conviction. This is not the time to trade in and out. If you own paper silver, ETFs, futures, or leveraged products, seriously consider converting to physical while you still can. The paper market may not be there for you when you need it most. If you own nothing, the question is no longer, should I buy? It is, can I still buy before supply disappears? Because that window is closing faster than most people realize. This is not just a silver story. This is a broader collapse of confidence in fiat currency. Look around. Gold is at $4,044, an all-time high. Silver is split between $91 in New York and $104 in Shanghai. Bitcoin is still holding above $80,000 despite wild swings. Real estate in major cities is surging as people try to escape cash. Farmland prices are hitting records. Copper, platinum, palladium, and other commodities are all rallying. This is not coincidence. This is a coordinated global movement out of paper money and into real assets. It is what happens when debt becomes too large, deficits become too reckless, and money printing becomes too extreme. Trust in fiat does not vanish overnight, but once it starts to erode, it rarely recovers quickly. The dollar did not become the world's reserve currency in a year, and it will not lose that status in a year either. But we are clearly in the early stages of that shift. And in that transition, hard assets like gold and silver historically perform exceptionally well. That $13 spread between New York and Shanghai is not just a number on a chart. It is a smoking gun. It proves the paper market has lost control. It proves the physical shortage is real. It proves the banks are trapped. It proves the system is cracking. Do not wait for CNBC to tell you this is serious. By the time mainstream media admits it, the shelves will be empty. Do not wait for your financial advisor to give you permission. Many of them are still stuck in outdated models that do not account for physical scarcity. And do not wait for a government emergency declaration because at that point, it will already be too late. Dealers will be sold out. Mints will be overwhelmed. The price will already be north of $200 and climbing. This is John A.G. from Currency Archive. It is Wednesday, January 14th, 2026. The spread just blew out to $13. Shanghai is at $104. India is at $132. The banks are cornered. The paper system is failing, and the physical market is vanishing. If you hold paper, seriously reconsider your position. If you hold physical, do not let go. The real price is not 91. It is not even 104. The real price is whatever desperate buyers are willing to pay when trust in money collapses, and that desperation is already arriving. The target of 375 is not fantasy. The timeline is accelerating. The squeeze is real. The paper market has lost control and the physical market has taken the wheel. The only question left is which side of history you want to be on. Like, subscribe, share this with someone who still thinks this is just another market move. And if you are going to act, do not hesitate. The door is closing. Go.